So, when the threat of a massive global conflict starts flashing on the geopolitical dashboard, you generally expect the world's biggest investors and central banks to do something fairly predictable.
Right, like buy gold, lock it in a vault somewhere, and just wait out the storm.
Exactly. So why, in the middle of a massive military escalation in the Middle East, did the global financial system suddenly rush to buy paper money instead? I mean, it is a completely upside-down signal.
It really is.
Welcome to this deep dive. Today, our mission is to make sense of a massive stack of financial data and market analysis that you, our listener, shared with us. We're looking at a flurry of mid-March 2026 financial bulletins.
Yeah, and we're specifically zeroing in on a highly detailed report by the financial researcher Doug Young. It's titled Iran War, Dollar Surges, Gold's Haven Tested.
Right, and the timing of this data is just critical.
Oh, absolutely. We are looking at a snapshot anchored around March 14th, 2026, and the markets are throwing off signals that, frankly, contradict decades of conventional financial wisdom.
So the mission today is to cut through that noise. We're going to decode the immediate reflex market reactions versus the slow-moving, long-term systemic shifts.
Yeah, that's the real story here.
And most importantly, we're going to look at the actual mechanics behind these numbers to figure out exactly how global statecraft is quietly rewiring the world's money.
But to do that, we really have to start with the physical reality on the ground as of mid-March 2026.
Right, the actual geography of it all. We are in the third week of the Iran conflict.
Yes, which follows those late February strikes by U.S. and Israeli forces on Iranian military sites.
And we have to highlight one specific target from those late February strikes, which is the oil export hub on Kharg Island.
Exactly. I mean, that is not just a military installation. It is a vital organ of the global energy supply.
Yeah, and Iran has retaliated with heavy missile barrages. Plus, Hezbollah has dramatically escalated its fighting in Lebanon.
And then you have U.S. President Donald Trump explicitly signaling a prolonged engagement.
Right, amid reports of U.S. military losses in Iraq, too. So the geopolitical temperature is just at an absolute boiling point.
It is. And right now, the financial markets are reacting violently to the physical threat to global energy.
Yeah.
Because to understand how the money is moving, you really have to understand the geography of that oil.
The Persian Gulf?
Yeah, Persian Gulf is an absolute choke point. Over 20% of the world's daily oil supply passes through those waters.
Wow. 20%.
Right. So when military action threatens that specific corridor, the market doesn't just calculate the cost of a delayed shipment. It calculates the potential for a catastrophic energy shortfall.
I mean, 20% passing through a single corridor is a massive point of failure. And the sources point out that the threat is no longer just contained to military zones.
No, not at all. We are seeing reports of kamikaze drone strikes on Dubai's International Financial Center.
Which changes the psychology completely. It's one thing to strike a naval vessel, but it's another entirely to send a drone into a regional banking hub.
Exactly. That combination, striking the physical oil infrastructure at Kharg Island and simultaneously attacking a financial nerve center in Dubai, it creates an immediate, visceral surge in oil prices.
Because of market prices, in the absolute worst-case scenario.
Right, a massive disruption in the supply chain that keeps the whole global economic engine running.
Okay, let's unpack this. The immediate surge in oil makes mechanical sense. The supply is threatened, so the price goes up.
Standard supply and demand.
Right. But if we look at the financial reaction to this geopolitical fire, the mechanics seem completely broken. I mean, one of our sources quotes the analyst Jeffrey Christian, who notes that global risk is currently at its highest since World War II.
Yeah, which is a very sobering assessment of the landscape.
It really is. So let's test that logic. If the risk of global contagion is the highest it has been in 80 years, the textbook response is to hoard hard assets.
Right, you buy gold.
But instead, we saw a sudden massive rush toward the U.S. dollar. So why did paper money win the initial panic?
Well, to answer that, we have to look at the plumbing of the global financial system, specifically the concept of liquidity.
Okay.
When an acute, sudden shock hits, institutions do not immediately look for the safest, heaviest asset. They prioritize maneuverability.
Maneuverability.
Yeah. They need a market that is deep enough to absorb billions or even trillions of dollars in a matter of hours without the system breaking down.
And the U.S. dollar, specifically the U.S. Treasury market, is like the only sponge big enough to soak up that much panic.
Exactly. Let's look at the numbers Doug Young provides. The U.S. dollar index, the DXY, climbed to 100.4976.
Which is high.
That is its highest level since November of 2024. Simultaneously, the 10-year U.S. Treasury yield rose to 4.044%.
Okay, so it's like grabbing the cash from your wallet to run out of a burning house. Rather than trying to dig up the heavy gold bars you buried in the backyard, you need what you can spend right now.
That's a great way to put it. And what's fascinating here is the underlying mechanics of the U.S. Treasury market. It is the deepest market in the world.
Meaning what, exactly?
When we say deep, we mean mechanically. There is an unmatched volume of buyers and sellers at any given second.
Meaning you don't experience slippage. Like, if a massive pension fund needs to move $10 billion into safety overnight, trying to buy $10 million of physical gold would instantly spike the price.
Right. And they'd end up overpaying for half of their order.
But they can park $10 billion in U.S. Treasuries, and the market barely blinks.
Exactly. The transaction happens frictionlessly. During a sudden shock, traders need to meet margin calls. They need cash to cover leveraged bets that are suddenly blowing up due to the war.
So the U.S. dollar is just the only vehicle that offers that level of immediate global utility.
Yep. But the yield data I just mentioned, the 10-year Treasury hitting 4.044%, that requires some serious explanation.
Yeah, because basic bond mechanics dictate that when demand for a bond goes up, the price of the bond goes up.
Right.
Which forces the yield, or the interest rate it pays, down.
Yeah.
So if the entire world is panic buying U.S. Treasuries as a safe haven, those yields should be plummeting. Why are they spiking over 4%?
Because there is a massive tug of war happening beneath the surface. You have the safe haven buyers pushing bond prices up, sure, but you also have the reality of that 20% oil choke point we discussed earlier.
Right.
When oil prices skyrocket due to military strikes, the market immediately calculates the cascading effect. Manufacturing gets more expensive, shipping gets more expensive, heating gets more expensive.
Which means inflation is going to surge.
Exactly. And inflation is the absolute kryptonite of a fixed yield bond. If investors believe inflation is going to spike because of energy costs, they will demand a higher yield to compensate for the fact that their future payouts will be worth less.
Oh, okay.
So that 4.044% yield is actually the inflation expectation overriding the safe haven demand. Investors are demanding a premium to hold U.S. debt in an inflationary environment.
That makes a lot of sense. But if all of this overnight liquidity is flooding into paper dollars to navigate the immediate crisis, that mathematically drains capital away from other assets.
Yes, it does.
Which forces us to look at the traditional safe haven gold. I mean, if the dollar's the liquidity sponge, what is happening to the buried treasure?
Well, the initial reaction was entirely by the book. Immediately following those first military strikes in late February, gold spiked to $5,296 per ounce.
So the panic button worked for a moment. But the data shows it didn't hold.
No, it retreated to around $5,175. And if we drill down into the specific daily data for March 12, gold actually fell by 0.67%, and silver dropped even harder, falling 2.01%.
Here's where it gets really interesting for anyone trying to manage a portfolio right now. You look at a screen showing a war in the Middle East, drone strikes on financial centers, and rising inflation expectations. Yet gold is experiencing profit-taking. Traders are selling.
Yeah, it looks strange on the surface.
The immediate assumption for a lot of people is that gold is fundamentally broken as a safe haven. Does this mean gold is losing its status?
Drawing that conclusion based on a 3-week window ignores the mechanical order of operations in a crisis. Doug Young's research provides vital historical context here. Look at the data from the 2024 to 2025 Iran-Israel exchanges.
Okay.
During the very first week of those conflicts, gold only averaged a modest 0.3% gain.
Less than 0.5% during the outbreak of a shooting war.
Yep.
Wow. I guess that proves the liquidity theory. In week one, everyone is just scrambling for dollars to cover their immediate liabilities and margin calls. You can't exactly pay a clearinghouse with a gold bar.
Exactly. You sell what you can, not what you want to. Institutions will sell their liquid gold positions just to generate the cash needed to survive the initial shock. That explains the slight dip and the consolidation.
Yeah.
However, step 2 of this historical pattern is where the wealth preservation mechanics take over. Following that initial 0.3% gain in week 1, gold historically rose an average of 9% over the subsequent 12 months during those previous conflicts.
Ah, so it is a two-step process. First, you secure the liquidity to survive the margin calls. Then, over the next 12 months, you systematically move your capital into assets that protect your purchasing power from the inflation generated by the crisis.
Exactly. Short-term liquidity flows dictate the dollar's immediate dominance. Long-term structural behaviors dictate gold's eventual rise.
Which brings us to the most staggering data point in this entire stack of sources. If gold is the ultimate long-term play, we need to examine who is currently playing the longest game.
Right, and it's not day traders.
No. It is the central banks, the architects of the fiat money system, are aggressively accumulating physical gold.
And the volume is historic. Central banks purchased an astounding 850 tons of gold in 2025, and current forecasts project them buying nearly 800 tons in 2026.
Let's put that percentage in perspective for the listener. That represents 26% of all annual mine production globally.
It's massive.
Over a quarter of every ounce of gold pulled out of the earth is being swallowed up and locked in a sovereign vault by central banks.
It is the fastest, most sustained pace of accumulation we have seen in decades.
And this is happening while other global markets are shifting. I mean, the sources point out that U.S. equities and bonds are currently trading at premiums, making them very expensive.
Right.
Meanwhile, European and Japanese markets are actually attracting reallocations of capital because those regions are implementing fiscal reforms to stabilize their debt structures. Money is looking for alternatives to U.S. exposure. So why are central banks choosing physical gold over other sovereign debt?
If we connect this to the bigger picture, we really have to look at the weaponization of global finance. This massive structural shift didn't begin with the March 2026 events.
Yeah.
No, the catalyst occurred several years ago, fundamentally changing how nation-states view paper money. When the West froze Russia's foreign exchange reserves following the invasion of Ukraine, every central bank in the world was taking notes.
Oh, right. Let's explain the mechanics of freezing those reserves because it perfectly illustrates the vulnerability of the system.
Sure.
When a country holds billions in U.S. dollars or euros, they don't have pallets of cash sitting in a warehouse. They have ledger entries in Western clearing banks and systems like SWIFT.
Exactly. A fiat currency reserve is ultimately a liability of the issuing central bank. If you hold U.S. Treasury bonds, you are basically holding an IOU from the U.S. government.
Right.
If that government decides you are a bad actor, they can simply refuse to honor the IOU. They instruct the clearing banks to blacklist your accounts, and your national savings effectively vanish overnight.
That is the ultimate definition of counterparty risk. Your wealth only exists as long as your counterparty, in this case the U.S. government or European banks, allows it to exist.
And gold is the exact opposite. A physical bar of gold stored in a vault in your own country carries zero counterparty risk.
Because it's a physical asset.
Right. It does not require a correspondent bank in New York to validate it. It does not require a connection to the SWIFT network to hold its value. It exists entirely outside the liability structure of any foreign nation, which makes it immune to financial sanctions.
So nation-states are basically realizing that the dollar comes with strings attached, and they're buying gold to cut those strings.
Exactly. By buying up 26% of the global supply, nation-states are building financial fortresses.
But how does this structural shift actually affect the everyday person listening to this right now?
Yeah.
I mean, we need to connect these massive geopolitical shifts back down to the listener.
Well, the transmission mechanism from geopolitics to everyday life is inflation and the cost of capital. Let's trace the path. Elevated oil risk premiums immediately ripple into the cost of everyday commodities.
Right.
The price of transporting food, manufacturing goods, and keeping the lights on goes up.
And that inflation eats directly into the listener's purchasing power at the grocery store.
Exactly. Then we look at the yield curves. We established earlier that a yield curve maps the interest rates of bonds across different maturity dates.
Right.
When inflation expectations rise, investors demand higher yields on long-term bonds. This forces borrowing costs up across the entire economy.
Mortgages get more expensive. Auto loans jump. Corporate borrowing costs spike, which means companies hire fewer people or lay off workers to maintain their margins.
Furthermore, volatile yield curves radically alter cross-border investments. Capital flows away from risky, developing markets and concentrates in safe havens.
Which affects everyone's retirement.
Yes. This turbulence dictates the health of international mutual funds, 401ks, and everyday retirement portfolios. The systemic risk doesn't stay contained in the Persian Gulf. It settles directly into your retirement account.
So what does this all mean for you, the listener? I mean, the data presents a complex duality here. The U.S. dollar remains the undisputed king of short-term liquidity. It is the only system with the depth to absorb a global shock today.
Right.
But given the evolving valuations, the massive premiums on U.S. equities, and the geopolitical reality of weaponized finance, putting total blind faith in a purely fiat portfolio might be significantly riskier now than it used to be.
Absolutely. The foundational rules have changed. You cannot rely on investment strategies that worked in the 2010s because the geopolitical landscape of the 2020s operates on entirely different mechanics.
Relying solely on a chart of past performance is a trap. You have to track these underlying valuations and historical patterns to contextualize why the shifts are happening. You have to know the difference between a temporary liquidity squeeze and a permanent structural reallocation.
And this raises an important question. The core educational takeaway from Doug Young's analysis is the absolute necessity of critical thinking. You must evaluate the resilience of your own portfolio through the lens of counterparty risk. Are your assets entirely dependent on systems that can be frozen or inflated away? Or do you have adequate insulation through assets that hold intrinsic value regardless of who is in power?
It is about understanding the mechanics of the assets you hold. It challenges a lot of comfortable conventional financial wisdom.
It really does.
But that is exactly why we break down these sources. We want to give you the context to see the entire board, not just the single chess piece in front of you. And we want to leave you with one final thought to explore on your own that pushes beyond today's data.
Yeah, the shift in behavior of central banks certainly opens the door to some massive questions about the future of global trade.
Consider this. If a block of non-Western central banks has quietly hoarded over a quarter of the global gold supply to eliminate their reliance on the US dollar, what happens when they decide to use that gold to back a completely new alternative currency system?
Oh, wow.
Right? If global trade begins settling outside the dollar entirely, how drastically does that alter the value of the paper money we use every single day?
I mean, the implications of a competing gold-backed trade settlement system would fundamentally rewrite global economics.
It really would. To help you navigate questions exactly like that, we formally recommend that you continue your own research by visiting the Gold IRA Company's bulletin website. You can find them at goldiracompaniescompared.com.
They have great resources.
They really do. They provide a wealth of related information on diversifying investment portfolios, historical data analysis, and educational resources on navigating these precise structural shifts and counterparty risks.
Analyzing historical precedents and structural data is simply the best defense against market panic.
Exactly. So the next time you see global markets reacting in ways that seem completely backwards, look at the underlying mechanics. Look at the liquidity, look at the yield curves, and look at the counterparty risk.
Because understanding how the financial plumbing actually works might just be the most important skill of our time.
Well said. Remember, there is a direct link to goldiracompaniescompared.com right there in the notes for this deep dive. Until next time, keep digging and stay curious.